Alrighty, let's go ahead and get started. Welcome everyone to the HUBB Live Trading Room. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do need to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like. But that's the main point to take away. The tariff roulette seems to continue, but the retail traders, that is, seem determined to buy the dip. And the question is that the right course of action? Interested to get into that discussion with Rob, and of course, very excited to interact with you all. So let's go ahead and kick off. Rob, you out there?
Hey, I'm Zack. Hey, everyone. Welcome to the HUBB Live Trading Room. Taking a look at what's going on in the market. Literally, there's news right as we are coming live here. Secretary Besant, I'm not sure exactly how you pronounce his name, was just on in a press conference calling out one of the Chinese officials and said they were flat out disrespectful in trade and negotiations. So that sent the market down a bit in the futures, but we'll see if that continues into the close. But to answer your question, Zach, or to opine on what you said, we can see that seems like in the morning we were trying to rally, and then we give some of it back in the afternoon. Started off that way today, and we have given quite a bit of the upward move back at this point in time. So my theory on this, or thought process, is that it's the last hour of trading that matters, because, as you mentioned, the retail trader seems still programmed to buy the dip, and why wouldn't they be? It's been working since the April lows. Every time we've had a dip, it's been bought. Looks like this one was headed that way as well, as we were able to get back above the 10-day moving average today, at least earlier in trade. We'll see if we stay there into the close. Volume is low. Thanks for that tip. We'll see if I can. Is that better?
Yeah, it's a lot better.
Okay. So we'll see if we can maintain this move above the 10-period moving average into the close. That'll be key. If so, then maybe buy the dip is still working. And all we did was have a test of the 50-day moving average, which all trending patterns do at one time or the other. So you come back down and test it. And we haven't really fully tested the 50-day moving average since May, when we first started the move higher from the April lows. So you could argue from a technical standpoint that this is normal, and you wouldn't be wrong. It is normal to have these kind of moves. The question is, can we take out this wave 3 high here and move to the upside? And if we do, I think what we want to look at is this newest zigzag here. So we had this zigzag, which completed itself and retraced back to the previous B wave, all in one trading bar. So we satisfied the 61.8% extension and then retraced all the C wave, which is the rules, in a triangle or in a zigzag pattern, all in the same day, which that doesn't happen very often. And we have a new zigzag potential here. It is qualified. It's not confirmed. It won't be confirmed until we take out this A wave high here, which coincides with where the wave 3 still sits. So can we do that? If we can, then there's your target right around 690 on the S&P. But we have to break this resistance area first, and any room in here between this little corridor that I've drawn is potential support resistance. So that's what a channel is. You have a support line and a resistance line. So we're just going to have to keep watching the market. It's still a stock picker's market, even maybe more so than ever. You've likely seen an invitation for a presentation between Jeff and myself tonight on generating income from trading, not dividend. It's not income from investing. It's income from trading, and income-based strategies should be a part of everyone's portfolio. Zach, hopefully you can put that link somewhere where people can see it if they haven't already signed up for it. It's free tonight at 8 o'clock. And with this move to the downside and a little bit more of a elevated VIX, not significantly so. We did get a little bit of a spike, but we are trading well with this little dip after those comments from Secretary Bessent. We are powering back up on the VIX, and I opined yesterday during Trade Finder, is that it? Did we just go up to resistance? That the mouth of the triangle on this big descending triangle in the VIX indicated a little more to the upside, and perhaps we do get that break above the 22.5 level and then move a bit higher. So caution is the norm right now, but pay specific attention to what happens in the last hour of trade. And this all started, it's always been important to watch the last hour. That's when the institutions trade. Pretty much anything up to that is mostly on the retail side. But what happened on Friday with this big bar down, you can see it in this volume underlay here, was that there was some sell on the close orders from institutions. That's what's known as forced selling. And if you've heard of forced selling before, but weren't really sure what that means, there is a requirement that institutions have a certain amount of money in cash available, readily available for redemption requests. And so if everything's bought on leverage or things are bought on leverage, and people start having to cash out from margin calls, or they just have to cash out because they want out, the institution has to have that cash ready to go. So they have to maintain that cash percentage, and they may not want to sell, but they have to, which is why it's called forced selling, to maintain those cash ratios. And that's what you can see by this big, huge bar that was accentuated right at the close on Friday, and we closed on the low. So then over the weekend, I posted commentary. What are the institutions going to do? Are they going to sit on that cash? Are they going to put it back to work? Because then we had another tweet that came out from President Trump on Sunday evening, right about the time the futures market opened, and said, don't worry about China. Everything's going to be fine. Well, over the last day or two, it doesn't look like everything is so fine. Now we've got a soybean versus cooking oil war going on. China hasn't bought any of our soybeans since May, so now we're not going to buy any more of their cooking oil. It's just back and forth, political posturing. But the comment that came out from Secretary Bessent on they were disrespectful, or at least this one Chinese official they determined to be disrespectful, certainly makes it sound like there's going to be a bit more negotiating needed. So the market had kind of tried to shake all that off until that. So at this point, let me give you a current quote on the futures on where we are. We had a pretty nice rally earlier. Now we're down 17 points on the futures. So you can see that all that rally from the retail traders in the morning, that highlights the point of why it's so important to watch the last hour of trade, exemplified perfectly with what's going on right now. So that's a bit of a brief update on what's happening in the markets at this point in time. We should check Bitcoin for those of you that may be in that. Up till now, no harm, no foul. If we can hold 60, that's going to be the key. We had this test of it back in September. We had a vertical break, a little too vertical. What goes vertically up oftentimes comes vertically back down. We got too far from the 10-day moving average. We were way overbought here, and so we came back down. Now the question is, can we hold it here? And I've talked about this a lot. Having a mentor, that's what we try to be at EWO Trader.com. Is a bit of mentors Mine, when I first started trading, had a rule: third time's a charm. In other words, the third time you tested either a resistance or a support level, the result of that test is where that market's likely to continue over the short to intermediate term. In other words, if we hold 60 here on BITB and bounce, then we're likely to continue higher from there. But if we fail on the test and break below 60, then we're probably going lower and maybe coming down here into this 55 range, at least on BITB, as evidenced by Bitcoin. So those are just a few things that sharing with you that I've learned over time. So we're again going to have to watch and see what happens in the last hour of trade. So let's get to the AI, which is what we focus on here. And you can see on the bullish side, the scores have gone down, which you would expect with that move in the S&P down on Friday, and then seeming like we may get some significant follow through today, the way it's looking at the moment. And that makes me want to immediately go to, let's take a look at the bearish signals. And you can see these scores are coming up. For a long time, we had scores in the 30 or 40 range, and we're getting a lot of scores here that are above 60. And Matador Resources looks pretty interesting at this point in time. You can see this 10-day moving average, 10-period moving average, moving lower. I like it because this one hasn't been, some of the moves down have been rather vertical, and that creates the same situation as when you have a vertical move to the upside. You look for consolidation, backing and filling, etc. So when it's been less of a volatile move lower, this one looks quite interesting to me as far as a potential move lower. I think it is smart. We added WLY yesterday. I think it is smart to put in some put trades just to balance the portfolio a bit. Doesn't mean that we're going bearish yet, but we may get there, which would be a lot of fun. So let's take a look at the options here and see if there's other resources that are more well known. And I was worried about this on the open interest. Switch over to the delta on these columns. And if we get down here towards, see, there's no, we're too low on the delta or too high. When you have a stock like this, if it's a low dollar stock, I don't mind going in the money. I've talked about that before. But when you have a $45 stock, you don't necessarily need to go in the money, but getting that delta at 69 as a 30-cent wide spread, which is still a bit too wide. Remember the 10% rule? Even if we rounded it up, that would be a spread of 15 cents, not 30 cents. So the open interest is a little too low. Spreads are a little too wide. That's on the call side. Let's go look on the put side. It's even worse. We do have a delta that would work at minus 38, but the spread's 70 cents wide. So, and you could actually be right and lose money on that one. So that's unfortunate because that chart does look good. So let's take a look at SMLR, similar scientific, and another one that has had a move down. Not great separation between the 10 and the 50-day moving averages. I like that for downside trades. And we had a bit of a move down here, got a little bit oversold, rally back up, letting the 10-day moving average catch up, consolidating for a couple days here. This one looks pretty interesting as well. I know the score is low at 60, so this would be a little bit on the speculative side, but some of these, and I don't want to violate the rules from what the data scientists say because I've questioned them incessantly about this. I talked about it during the insiders meeting as well. The fact that a lot of these bearish trades with lower scores seem to be working really well. And shouldn't we maybe drop the range from 70 to 75 on the bullish side, drop it down a little bit on the bearish side, and they maintain because they've looked at mounds of data that no, stay with the same guidelines and the same rules, qualifications. But sure, it's tempting on some of these. And then if we look at the CCI, you can see it did get near that extreme point low and it's ticked back up a little bit. So being cautious here certainly was warranted. And then on the downside trade, I also like to look at money flow. Is money leaving or going in? Are they buying the dip or are they bailing? And this is moving up also. So perhaps listening to the data scientists is prudent here on staying away from this one with the potential that it could turn around and bounce back up. But boy, it looks awfully enticing because that was pretty good support right there that we've broken. And it doesn't really seem to have much if we condense the chart. Well, I guess there is right in this area, but we got to go back to fall of last year, a full year ago, to find that support area. But it does exist. So that's another reason why you want to go back at least a year in time when you're looking for support and resistance lines. That's another general rule. I've had that question asked before. How far back do you go to look for support and resistance? For me, it's a year. I don't really go much further back than that unless we're looking at a weekly or monthly chart. Then obviously you go a little bit further back. But for the daily chart, a year is, and that's kind of the standard norm there. And then PAA, if we take a look at that, Plains All-American Pipeline, again, a 60% score. Looking at the CCI is back up to negative 100. That's an area where maybe we could roll back over. So that's the difference. That's what I like to see out of the money flow. Notice the difference on how they've been bailing. Money has been leaving this. It hasn't been bought into like the similar scientific was. So that's a different scenario. Again, why we use these confirming indicators. And as you know, in this show, I always try to just give some ancillary tips and from my experience, along with the AI. The AI is great, but just like Elliott wave is a great indicator, but you would never want to rely solely on one indicator. Same thing with AI. AI is amazing. It's helped improve Elliott wave, which is pretty amazing in itself. But I still like to have the confirming indicators back it up. So that gives you a little bit of an idea of what I'm looking at there. It's a lower dollar stock, so the move down is less than $1, which is not ideal. The setup with a bounce today looks nice. I'm not sure what the options may look like here on PAA. I have heard of this one. There we go. So open interest is a lot better, but still not much on the spreads. The 17 isn't too bad. It is in the money. And as I just mentioned, when you have lower dollar stocks, I don't mind going in the money. Delta's at 71. The spread is a tiny bit high, but not exorbitantly. So, if you split the spread there, call it 108. So you would want it about 18 cents wide is 15 cents wide. So that'll work on if you wanted to do something. It's just borderline on being too wide. So excuse me, not 18 cents, it'd be 10.8 cents. And it's 15 cents wide. Basic math, 10%. So it is a hair wide, but not that bad. And there's a lot of open interest there. But we wouldn't do October options. And immediately you can see it has weeklies. So that tells you right off the bat that there's likely some decent liquidity. We probably want to go out to January on something like this. So if we look at the January options, the spreads get a touch wider, but the liquidity is still really good. there's that 17 strike that we were looking at in the November options. And right there, it's at 9,000 contracts plus 20-cent wide spread. Once again, a few cents too high. 15 cents would be ideal. So not bad, really, right here. And the only negative when looking at this is the fact that it is a 60% score. Pretty tempting though on this one. So let's bring the chart in a bit and then see where if we had that same problem of going back a year. And notice that we don't. When we look at this, the support was right in through this area, right through here, which we broke. We are bouncing back up, but that could provide a good entry point because we got a little oversold from the 10-day moving average and we're bouncing back up. But that red line indicating support somewhere in the 16.10, 16.15. If you wanted to be a little more conservative, you could say 16 level even. The only problem, in addition to the score, is it's just not that big of a move. But that's why we are okay with going in the money on these lower dollar stocks, because this is the norm. They tend not to have big moves. You don't find a $16 stock forecast to go down to 10. When you have these stocks under $20, a dollar or two move is about all you're going to get. And just to further that point, and then we'll move to the Q&A after looking at a couple more of the results. But when you're talking about, we go out of the money because we want that delta gamma relationship. We want that acceleration of delta through gamma so that it puts the math in our favor, the greatest acceleration of math. But when you have a smaller move, you don't really have enough room for the acceleration to occur, if that makes sense. You need a decent price movement so that you can capture that acceleration. So if you have a dollar or less of a movement, then in the money would be better because the movement's going to be small and you probably wouldn't get that delta gamma acceleration anyway. So you might as well take more of it on that $1 move. So I hope that makes sense on why, because we've had that question before when I've sent out an alert on a lower dollar stock and it was in the money. We talked so much about trading out of the money options, using that delta gamma acceleration. So I can understand why it's confusing when one comes out that's in the money. So I wanted to give a little more of a detailed explanation of that. So hopefully that makes sense. If we look at the wave 5 bullish, man, this search is going to be full of results here soon. Because of this downward move. This will complete some of the downward moves. And once we start to bounce back, I expect there to be a ton of results on this, which will be really exciting. Here's RLI. I'm not really familiar with this company here. It's a little below the target zone. So that tells you be a little bit cautious if it breaks below that blue box. Now let's see what the options look like just out of curiosity, because that's the highest score I've seen on a wave 5 bullish result. And then unfortunately, you can see open interest is basically non-existent and the spreads are in the stratosphere. So it doesn't really matter that this one's broken below that level. But then we have another one here. Look, we have several with scores in the 80s. And we're going to have to watch the market. We have bounced a little bit since we started after the drop from those comments from Secretary Bessent. Can the market shake this off? I still say let's watch the last hour. The VIX is holding in there. So even though we've had a little bit of a bounce, a small bounce, the VIX hasn't ticked down much. So there could be some volatility going into the close. I don't know that I would be very active doing anything today. I'd really want to see if we can close above that 10-day moving average. That would be key that I would be looking for. But really exciting to see higher scores on the wave 5 bullish search. And this one's still in the blue. area here. And if we can have a little bit of a move back to the upside, then these are going to be the ideal scenarios. There's two things in play here. One, once they complete their wave fives down, and it's yet to be seen if this one is finished. It got right to the top end of the tap box, but with a 50% wave four correction, that wave five could come lower. We could get a little more into it. But if we can hold here and start to bounce, then we have a pretty good move back up to the previous four. So that one is quite interesting. And the AI doesn't think that it's likely we go much lower from here. So this is a good one to keep an eye on. Let's see what the options look like here on Booz Allen. I just skip October. The first thing that I look for is, does it have January options? Because those are leaps. And usually if it has leaps, there is some liquidity in the options. Notice that there's a little more liquidity on the put side than the call side, which you would expect when a stock has been moving lower. That's okay. That doesn't bother me. In fact, I like it when the majority of traders are on the other side of where you're wanting to go. So this would be back on the call side looking for a bounce higher, but man, it just not really much open interest and really wide spreads. December, we could look at a little more open interest here, little tighter spreads, could probably make that work. The 46 delta, the at the money option being a bit better than the 38 delta option, because that spread's too wide. $2.50 is too wide. If this is indeed only a 60-cent wide spread, that would be good. But sometimes these spreads change because there may be an order sitting there that makes it appear that it's tighter. When we go up to the 95 strike, that one's only 70 cents wide, which is good. That's below the 10% rule. But then you go up to 90, 80, 85, 80, bit wider spreads, but not out of the realm of possibility. So let's keep an eye on what happens on the market into the close. And if it does look like we can recover from this, and it isn't going to be another Friday event from all the tariff back and forth that's going on, I like your term of tariff roulette, Zack, back and forth, back and forth. It's going to be okay. No, it's not going to be okay. We're just in a big spinning wheel here with tariffs being in the middle. And it's giving the market an excuse. It's giving traders an excuse to take profits, which is, we had gotten to the point where we were a bit immune to all the tariff stuff after everything that happened in April and all the big reactions, kind of got immune to it. But then when we have such a big continued rally, people say, okay, I'm not going to risk this. I'm just going to go ahead and take some gains, especially as we're starting to head to the end of the year. And their bonuses are dependent on their performance going into the end of the year. So I do like the looks of this December 100 call here. It is a little higher than our normal risk tolerance. We try to keep an alert at $500 or less. So that's a little bit frustrating, but we can't go down to the 105 because the spread's too wide. But if we could indeed enter this one, it would probably have to be in the speculative portfolio because it violates that $500 rule. And remember, to be in one of the three primary portfolios, the level 3 portfolios, we need to stay within the rules and guidelines. The speculative portfolio allows us to send out alerts that may not follow to a T the rules as defined by the strategies within level 3. But super exciting here to see these. And then let's look at PB, Prosperity Bank shares. The main banks, Bank of America, JP Morgan, they've had pretty good results. And I thought they would be decent, and disappointed if not. There are some regional banks that have not been performing very well. And then you get all of this rhetoric that is 180 degrees opposed from each other. as far as I'm just going to highlight one incident where there were news reports that the auto loan defaults were very high. I don't want to say all-time high. I think that's what I heard, but I'm not convinced enough to say that, but they're high. And then with the financial results that we've been getting over the past 2 days, they say that auto loans are solid. So it seems like some banks maybe, and that was what the analysis was, because the host questioned them on that. How can that be? And then the result was, well, maybe some banks have lessened their, restrictions on getting an auto loan, and it's coming back to bite them. And those that have had more strict guidelines on getting a loan are seeing things perform okay. And that makes sense, obviously, from a common sense standpoint. But we're sitting right on support here. This one looks quite interesting as well. Not really familiar with Prosperity Bank shares, so I'm a little nervous when we go to look at the options if there's liquidity here. But this could be a really good one. We had a 73% extension and made it almost to the middle of the tap box. We've rebounded. We're in the blue area here, which is the ideal entry zone. And we could have a move all the way back up to 70. That looks really, really good. So fingers crossed on the options here. Again, we're not going to do anything at least until that's frustrating. That's probably the best setup of any of them I've seen. But again, the first clue, no January options, so no leaps, tells you you're probably going to be thin in the liquidity. If we go to December, we have a little bit of liquidity, but those people are trading against the market makers with mile wide spreads. This is not a smart thing to do. So that sucks, but sorry about the term, but it really does, because again, that was the best setup that I saw out of all of them. And then EPRT, I thought this would be a REIT, and it is. And this kind of makes sense as well, with the fact that rates going down could be a boom back to the housing market, not a boom, a bid back to the housing market that has been kind of in a big downtrend. Look at that nice zigzag on the way down here. So this one looks interesting as well, except for I really don't prefer to trade REITs. They tend not to move fast. But we stopped just short of the 100% target level there, which would have been more ideal. But we are back above the 10-day moving average, back above if we close there, and we may not, depending on what the market does. And it's getting some of that downward move back. So at least for now, people are buying into that dip from those comments from Basent. This one only a 72% score, so it would be a little bit low, and I'm a little worried about the options here, but let's see. Take a look. There are companies that I've not heard of that are more heavily traded. At least it does have January options, so we have a chance here, but nah, not really. Zero bid on the 40 means nobody's trading it today. When you see that there is open interest, but yet you get these dashes here, it means that nobody's traded that option that day. So you can put in a price somewhere, wherever you want to put it, and then the market makers have to look at it. Maybe they take it, maybe they don't. But when you see these dotted lines, that means nobody has traded it today. So even though there's 148 contracts of open interest, nobody's traded this actual option today. Yeah, not really interested in those spreads either, but really excited to see the activity on the wave 5 bullish, because I do think that's where we're going to be in the next few weeks moving forward. And then we'll finish this up before we open it up to some questions on the sideways, because I think these are going to be a great place to be as well. The scores are too low right now, but with this little bit of a downdraft, especially now in earnings season, there's going to be so much attention paid to not only what the results are, but what the guidance is. And I think we're going to see a lot of potential time strategy candidates from the earnings report, because we're in an area of no forgiveness anymore. We went through the area of good news is good, bad news is good. But now, with the fact that valuations are so high, you've got to perform. So now bad news is bad. It can't be viewed as good. And so on earnings, we're going to see some big movements down, and we just started earnings. So I expect to see an awful lot of really great results here from the sideways search for our time strategy, which is what we'll be talking more about tonight in the generating income. All right, Zach. So with that, let's go ahead and open it up to some questions before we wrap things up.
Sounds like a plan. Got a question here from Maria. Is SMCI consolidating or running out of gas? Based on the ADX, there are two qualified zigzags from 60 to 70.
Yeah, Maria, as you know, I've been keeping a close eye on this one as well, dying to get into this, not so interested with the craziness of the market currently. Just kind of want to see where we go on the S&P moving into, and the Fed is pretty much, Chairman Powell was all giddy in his um, uh, interview that he did yesterday. And it does seem like those next two rate cuts are going to happen October and December. So that won't disappoint the market. So that part is good. That could be a constructive to move up. And with lower rates, that should help tech stocks and SMCI, as we've talked about. Maria has underperformed. I would look at this, and you're talking about the two zigzags. If you're looking at this big one here, which maybe this isn't it, but that one is disqualified because the B wave is at 83%. So the downward zigzag doesn't count. It's disqualified. It was qualified. It never got confirmed because it went too high before we started back down. And then on the way up, I'm not sure we're quite qualified yet, but let's see. Well, it's at 30%. I prefer it to be 38.2, but look how we're trying to hold the 10-day moving average. So, Maria, I still think this is one to keep an eye on, because and you were the one that asked the question, a great question on performance chasing by institutions moving towards the end of the year. This is one I think they could look at because it hasn't performed like Broadcom or Nvidia or all the other big tech stocks the way they've been moving. We all know why. They went through all their accounting issues, et cetera, all those things. I think this one merits continuing to watch. I really want to see, pardon me, I really want to see the last hour of trade today, though. And I would like to see, this is not a significant point of resistance, but it's a small one. And it might be being a little picky, but I would want to see a break above that. So a break above 54, if you will. And then I think we at least test these highs from July, and maybe we could be really off and running here on SMCI. So Maria, I would keep a close eye on this one, keep it on the watch list. And I'm not prepared to do anything today. We are bouncing back from that sell-off move, but I really want to see the last hour. I want to see how the institutions are thinking about the fact that the tweet on Sunday of everything's going to be fine. Maybe it's not going to be fine. It seems like there's going to be more of a war of words and posturing before we end that. So, but let's keep watching this one. All right, Zach.
A question from Elizabeth. I'm curious as to why Rob was looking at options that expire this week on MTDR when looking at delta and spread. Wouldn't looking further out in time make more sense?
Well, I think she may have written that before I moved on, um, because I looked at those initially and then moved to later months. So I think that question probably got answered when I was going through it. I did initially. I was just curious, and the reason, um, just for the knowledge, is you're going to have the greatest amount of open interest in the front month options. So if you look at the front month and it's weak, you're likely not going to have any better liquidity going further out. So why bother? Because where do we go? Do we go to December? Do we go to January? That's how we have to choose. And then we can start looking at open interest in the best delta relationship further out. But if you look at the front month and it doesn't have options, probably not even worth going through all that, because the highest open interest is always in the front month. So maybe that explains why I looked at it. But I did go and look at other months after that, I believe. I know I did on some of them, but that's the reason.
And I think this next one you also answered as well. So just a quick refresher on the blue box meaning. That's the ideal entry zone. Is that
Correct.
correct?
Yep. So
All right.
what they're saying is, because on a wave five trade, um, we can get a wave five down and then bounce, right, and then continue lower, and the wave five extends further down. So what they're saying is that if you're still in that blue box, that's the ideal entry zone. If it's traded down below that, that's caution. We could go lower first. It's showing all the characteristics of a bounce back to the previous four, what's known as a wave five bullish trade. But it might be a little bit early if it's below the blue box. So yeah, that blue box is your ideal entry zone. So you want to pay attention to that. Glad we clarified that.
Indeed. And David said this is just going back to BAH. The 110 strike calls have better open interest.
Back to Booz Allen. Um, so I'll bring the options up again, and not sure what month we were looking at. We were looking at the January ones there, or December. The 100 strike. Um, there's only 22 contracts there and a mile wide spread. On the December, the 100 strike did have better. Oh yeah, that's the one. That's why. If that's the question, you could see. Now I remember. You could see on the January options, the 100 strike, the spread's a mile wide, very low on open interest. But December is a bit better. The spread is okay, even though it's a little bit outside the normal risk parameters, but 349 contracts, less than a 10% wide spread, or right at our 10% rule. So that December 100 call looks pretty interesting. But again, I'm not sure I'm going to pull the trigger on anything today. That's how important I feel where we close today is based on this back and forth that the market's done over the previous couple of days. And I do want to add this commentary in there. This kind of volatility, jumping back and forth here after a big drop, is also characteristic of building a bottom. The sellers step in. Can they press their bets and push it lower? Buyers come in on the buy the dip. Who's going to win out? So this kind of stuff is not unusual, and could actually be viewed as a bit bullish as long as we don't violate that 50-day moving average. So if we bounce back and forth through here, the more conservative play is to wait until we break above this wave three and A wave high, the wave three and the five wave pattern, the A on the zigzag. But aggressively, I still think you can follow the AI signals and pick and choose the best of those. I think that's fine. But for right now, today, I want to see where we close. And then we'll probably see several alerts come out tomorrow, maybe on the bullish side, maybe on the bearish side. That's how much I think the last hour today matters. So we're continuing to recover the bounce, or we're continuing to bounce from the downward move. And if we can hold that into the close and reverse this and actually finish back positive, then that would be a good sign. So we're back up 12 points where we were down almost 18 points when I looked at it before. So maybe buy the dip still works. And some of those wave 5 buys, Booz Allen included, would be good setups. So yeah, keep an eye on that one.
And David was just clarifying that it was the 110 calls on each month versus the 100 for the strike.
Let me go back. I didn't go that far, so let me expand it out to where we could include the 110s. Well, the open interest is bigger, but it hasn't traded today, so you'd be the first one on the 110s. Oh, that's October. Sorry. Let me get back to December. Spread's a little wider. The open interest is greater, but the spread's 65 cents wide. So it is less expensive. Delta's more in our range. Even the 38 Delta spread's too wide. I'm not willing to give away that much on the width of the spread is the problem. It's about double what we'd like it to be. Now you could try it as far as splitting the spread to get in, but remember where they catch you is they let you in, but then when it's time to get out, let's say this was the price you'd made money and you're ready to get out, so you would be selling between 230 and 295, and you put an order in to close it out on the midpoint. And then they say, yeah, no, we're going to make you go all the way down to the bid, which means you're giving 20 plus, maybe 30 cents away of the gain that you would have made on the spread. So, as long as you know that going in and feel like you can make more than that, then that's okay. But I think I would rather pay a little bit more up here, a little less open interest, but with the spread being a little bit tighter. But I understand your question now, and it's a good point. You just kind of have to weigh out between those two, greater liquidity, if they allow you to do that. Get out
Very
of
well. And I think that covers all the questions. You summarized it all very well. So I'll pass back over to you.
All right. Well, let's watch the close. And I'm not sure there will be too much activity today unless we get a clear-cut move between 2 and 3 in the beginning of 3 o'clock, but probably going to see the close today. And then as we went through the AI charts, we have several opportunities, both on the long side and the short side, to send out. So that's always a good thing. It's never bad to balance out the portfolio in times of higher volatility. I will say the VIX has come down a little bit with this part of the rally. Initially, it didn't, but as we've continued to bounce, the VIX is down, still above 20, almost to 21. But if we continue to rally and the VIX continues to come down, that could be a bullish sign going into the rest of the week, and then the bull case is back on. So yeah, we'll keep an eye on it and see how things play out. But as always, thanks for taking some of your trading day to attend. And hopefully we'll be seeing y'all tonight at the Generating Income event and tomorrow night during our normal insiders meeting. So have a great rest of your trading day. You know what to watch. Look forward to talking again soon. Take care, everybody.